Well, hello friends, and welcome back to the remainder of derivatives. We have one more reading to go, and that is the reading on valuation of contingent claims. So what do we have in here? Remember, contingent claims is another fancy word for options, and all sorts of options are covered in this reading. Now, as far as the exam is concerned, the key aspects are understand the binomial model and derive the hedge ratio using the binomial model. We will look at the hedge ratio and compare it to a exact counterpart of the hedge ratio under the Black-Scholes model, and we'll look at the compare and contrast the two. Now, a very important material qualitative question from this reading is the equivalencies between different interest rate derivative contracts. So different contracts that we have already seen in interest rates. For example, one of the contracts that we talked about is forward rate agreements. Those are interest rate forward contracts. And similarly, you have swap contracts, which are also deriving their value based on interest rates. And finally, contracts or options on fixed income securities bonds. Now here in this context, we have interest rate calls and interest rate puts also embedded, also included on top of it, as well as options on swaps. So we call it swaptions. So we look at all the interrelationship equivalencies. Why? Because the pricing in the market should conform to these equivalencies. Don't get bogged down by the Black-Scholes model. When you look at the model, it's what I call as our ugly formula rule. The uglier the formula, the less likely you're to actually use it for calculating anything on the exam. So however, again, the Black-Scholes model is for valuation of an option. The Black model is valuation of options on futures. So Black-Scholes valuation of options on stocks, and then Black model is for valuation of options on futures contracts. Basically a minor tweak to original Black-Scholes model to get to the Black model. But again, don't memorize the models themselves. You're not going to use them to calculate anything. The only thing you want to know is the replication. That's the key. How do you replicate a call option using units of stock and risk-free bond, as well as how do you replicate a put option using, again, units of stock and risk-free bonds. And then finally, the assumptions behind Black-Scholes model, as well as the Greeks. One key assumption that we'll emphasize as we move along. All right, let's move on to the binomial model. So the binomial model, basically, as we already know, binomial means what? One of two possible outcomes. So in the next period, the value of the variable will change to one of two possible outcomes, one of two possible values. So we have already seen the binomial interest rate trees. Remember, one of two possible interest rates, up or down. And the same thing here for a stock price. You can think of a stock price tree. A stock price in the next period can be a high price or a low price. And again, when I say high price, doesn't necessarily mean above the current stock price. It doesn't always necessarily imply that. But usually it is. High price is above the current stock price if the risk-free rate is positive. We'll see that in a second. All right. So let's look at the stock option. Let's look at the stock option metrics that we need to know. So the U stands for the probability of size of